Okay, so let's get started. So we'll finish off, we actually finished off our talk of price controls. The next topic in chapter 5 has to do with market efficiency. So in this discussion, we're just going to think about how, in theory, how good a market is. And then if you do something like enact a price control, how that could affect the overall efficiency. And we'll see it causes what's called a deadweight loss, meaning there's mutually beneficial transactions that, that are of value and then they don't occur. So again, when we looked at price controls, we were thinking of the government basically, interrupting the operation of a market and putting either a price ceiling or a price floor. So for example, a minimum wage would be a price floor on wages. And, our simple model would suggest that that would cause unemployment. Another example would be rent controls. That would be a price ceiling. Does that make everyone better off when we do that? So a way to analyze and answer these types of questions, basically the question is, does this make everyone better off, or does it make everyone worse off? What's the effect of interrupting or meddling in the market? So we use this thing called market efficiency to answer these questions. This is, a very simple overview. The first thing we want to do, just to get a feel for why a market system is better than, say, a command system. A command system would be where the government, like in North Korea or Cuba, the government answers all of the economic questions directly. They decide what to produce, how to produce, etc. And we learned before in chapter 1, in a market, we don't have that. So one way to show that a market will, is pretty efficient in terms of allocating resources to where they're needed is to sort of recast the demand and supply curve. So we can look at the demand curve differently, and we could think of it as a marginal benefit curve. So if you think about the demand curve, all it's telling us is the high, each point on the demand curve, we can interpret it as what's the highest, what's the most a customer would be willing to pay for this unit. And the answer would be, we start with the quantity and we go up to the demand curve and list off the price. That would be the most someone would be willing to pay for a given unit. And so we can think of the demand curve as showing the value to consumers from consuming that unit. So if you think of an auction and you're the person in the room with the highest willingness to pay, you're going to win the auction. You're going to bid the highest. And you can think of that price that you would pay if you won the auction as being your, it's your maximum willingness to pay, but it's also how much you value the good. So that's sort of the idea. And then you can think of the supply curve as, we can recast that and think of it as being the lowest price, the lowest price that producers would be willing to accept for a given unit, right? And the market supply curve shows the lowest acceptable price for firms, two firms for selling that unit. So and this is because if you think of the cost associated with producing the good, then, that's why they would, some firms would accept a lower or higher price. So it's easier to talk about this when we look at an actual demand and supply curve. So if we look at this demand curve for each unit of pizza, so say we're thinking about the 100 units of pizza. So if we go up to the demand curve, think about going from 99 to 100, that extra pizza. Well, that extra pizza someone is willing to pay $20 for, according to this demand curve. So that must be the value to that person of the pizza. They'd be willing to pay that amount. And so if we just move along here and we wanted to know the value of the next good, 101 units, it would just be somewhere here below 20. So we can think of this demand curve as the marginal benefit curve. So, if you increase a unit of pizza, what's the value? So if you actually were to produce that and it would get into someone's hands, what would the value be? Well, it would be just the price. So we can think of this as the marginal benefit curve. So here it just explains this more formally. Each point on the demand curve shows the maximum price consumers are willing to pay to consume that unit. This maximum price reflects the value that consumers get from that unit of the product. Is that clear? So that's all the demand curve is. It's just telling you, what people would buy at different prices, but we can sort of just recast it and say, well, this, this 100th unit of a piece of pizza, what's the maximum someone's willing to pay for it? Well, we would learn that by going up to the demand curve and going over to the left. Now, on the supply curve, we are thinking about, okay, in order for a producer to produce an extra pizza, say from 199 to 200, they would require at least this price that's indicated on the supply curve for them to offer it for sale. So we can think of this as the marginal cost curve of supplying the good. We'll get into this. Cost is a little more general, and we'll talk about this actually in the next chapter tonight. But when we think of cost, we're not just thinking of explicit costs. So if you're a firm or a business and you're offering something for sale, the cost of producing it, the cost of the inputs, the labor, and everything you're spending money on to make it is one part of it. But the owner of the business is also, dedicating their life to this business, and they're giving up, other things. They could maybe work somewhere else and get paid. They could have borrowed money for the business, and so they're giving up, the returns they could have gotten in the stock market for that money. So the costs here are also including the opportunity costs of the owners of the firms. And so, it's a little more general of a concept. So you can think of two people running the exact same business, same cost structure, everything else, maybe two people running a dry cleaner, right? They both have this exact same dry cleaning business. They have all the same equipment. Their locations are similar, not close to each other, but similar in terms of, maybe they're both of them are good locations somewhere in the city. But if one of the owners of the dry cleaner is, say, a nuclear engineer, or, has very high education like that, and they could make $300,000 a year working as a nuclear engineer, well, their cost of producing that dry cleaning service is very high compared to the other guy who maybe doesn't have that high level of education, because we're going to include their opportunity cost. And so, as we'll see in a market, we won't see, allocations like that because the costs would be too high. Like you wouldn't, in a market system, you wouldn't get unusual allocation of people into different jobs and that sort of thing, or owning businesses, if their opportunity costs are very high. In a command economy, you could, because the government would just dictate whether it makes sense or not. But in the market system, it's a bit different. So the bottom line here is you can just interpret the demand curve as a marginal benefit curve, and the supply curve as a marginal cost curve. Okay, and so we're going to say that's the marginal cost curve and the marginal benefit curve. Well, if economic activity is being driven so that, only goods or services are going to be produced if the marginal benefit exceeds the marginal cost, and when it's not, it stops, then you could just imagine that in theory, you would get a perfect allocation of people to, being owners. And, you're not going to end up in a situation where someone produces a good that no one, that the consumers don't value, and that it costs them more than what the consumers value to produce. So the idea is basically, let's first just look at the demand and supply curve and look at this triangle area here. Okay, so we call this area surplus. And it's surplus because the value to consumers on any point here, which is on the demand curve, remember we said any point on the demand curve could represents the value of that good or service to a consumer. Okay, so that's what all these points represent. And then all these points on the supply curve represent the cost to a firm to offer that for sale. And so this difference is the value of the transaction. So this 100th unit of pizza is worth, just under, or $20 in this case, to the person who wants to consume it. But the firm, its cost was only $5, including their opportunity cost. So if this transaction occurs, it's beneficial to both parties. Okay, and we'll see in a moment. Let me see if we get into consumer. Yeah. So we'll do that in a sec. We'll explain why, how it's about, what exactly the surplus is to the consumer and the producer. But you can clearly see that, this at any unit here, the vertical distance represents the value of that transaction occurring. Okay. And so if you look in a market, you produce up into this equilibrium point of 250. And so this whole area here would be surplus. Is there any way we can get better surplus? Is there another quantity here that we could improve on this? Anyone? You can use the mic if you want. If we made 300 pizzas, would the surplus be better?
Wouldn't that be equilibrium? Well, 300. Or no, 250 is equilibrium.
Yeah, so that turns out to be the maximum, right? So let's just look. If we produce 300 pizzas, well, these 50 pizzas, for these 50 pizzas, if we look up the marginal cost of producing them would exceed the marginal benefit to consumers. That would be stupid to force on people, right? That in a command economy, they might do something like that, but in a market economy, it won't, because this is where the market will tend to, where the quantity demand equals quantity supplied. You could think of the shaded area here as negative surplus, right? Because if you forced these people to engage in this transaction, they wouldn't be happy. They'd be worse off, right? You would have someone making something that their cost exceeds what the value is to consumers. And so in a market, we go up to this point and that's it. If we, for example, only produced 100 pizzas, then we would stop here. This area here would be surplus, right? But we would be missing out on all this, because all of these units up to the equilibrium point are such that the value to consumers exceeds the cost to the producers to offer them this for sale. So this would represent all mutually beneficial trades that would not occur if the quantity was forced to be 100. So we can also think of the idea of a benevolent social planner. So imagine that there's someone the opposite of maybe Donald Trump, who's this smart, powerful, well-intentioned dictator, and they would do everything perfect to maximize the benefit of society. So in other words, you want them to, we're just thinking of economic value here. This is economics course. We're not thinking of, non-economic things, but you get the idea. So if there was a person who was like this and they were able to maximize the economic well-being of everyone in society, well, they would want to maximize total surplus. So, there's millions of different markets and transactions that occur. They would want to maximize total surplus in each market. Basically, on the whole, you would want in order to maximize surplus, you would only have people engaging in producing a good or service if the marginal benefit exceeded the marginal cost, and stop when they become equal. And so their goal is to basically maximize total surplus. Now, let's distinguish between consumer surplus and producer surplus. So consumer surplus is the value to buyers minus the amount paid by buyers. In fact, I'm going to go back to this diagram. So again, each point on the demand curve represents the value to consumers. Now, in a market, what price do they get charged? What's the price that would prevail in this market? Anyone? Don't be shy.
What is the price that would prevail? It would be more beneficial to them? Or
no, what's the market?
$12.50.
Yeah, it'll be $12.50. So in this market, if the price is $12.50, this guy here is willing to pay, I don't know, that's probably roughly $30. That's how much that good is valued to him, but he'd only have to pay $12.50, right? And so this vertical distance here would be consumer surplus. And so all of this whole area here, the triangle above 250 but below the demand curve represents the part of the surplus that would go to consumers, right? Because they value the good more than what they had to pay for it, right? There's only one price in a market. And of course, we'll probably cover this later. If a firm could actually know what your willingness to pay is and charge everyone a different price according to their willingness to pay, I guess the closest thing would be something like trying to auction every single unit that you're selling, right? So if you had a business and you decided to just auction your whatever you're selling, each unit, just have an auction every 10 minutes online or something like that, then the price you'd be charging would be getting close to people's willingness to pay. Airlines kind of do this too because they have a very complicated algorithm that is trying to do just that. They're trying to figure out what exact price, your maximum willingness to pay. There's higher prices to fly home on a Sunday night because a lot of business people would have high willingness to pay for that. They're much more complicated than that. They do all kinds of things. But
just like when you're saying Mexico or whatever, you're going to all these street vendors where they sell you this price and then you just barter back and forth for the price that you're willing to pay.
Yeah, that's what, or at flea markets they try and do that too. They're kind of sizing you up, trying to get the best price they can possibly get. So if that's occurring, then they're sort of they're taking away the consumer surplus, right? That's what they're trying to do. But for many markets though, that really doesn't always happen. But for the simple market model that we're looking at here anyways, we're just saying there's going to be one equilibrium price that will be paid. And so then the area above that and below the demand curve would be consumer surplus. But there are ways that firms could try and, extract this consumer surplus simply by trying to figure out what your willingness to pay is. But for the most part, a lot of markets we see there's remember, this is just a very simple model in theory, without those sorts of things. There's just going to be a price that the market would tend to go to, and that's the price that would clear the market. That's the price where the quantity supplied equals quantity demand, and everyone's happy there's no surplus or shortage. So anyways, that's consumer surplus. And then producer surplus, well, if we just think about it, what do the producers get out of this transaction? Well, they get the price, okay? And then their marginal cost is what they're paying for that. So, at a point 100, the cost is $5, but they get $12.50 as a price. And so this would represent surplus. So this triangle here below the price but above the supply curve or the marginal cost curve is producer surplus. Okay, so this whole triangle represents total surplus. This is consumer surplus, and this is producer surplus. Now on this next slide, we're just sort of looking at just defining each one. So consumer surplus is just, as I said, the value to the buyers minus the amount paid by buyers, right? And producer surplus is the amount received by sellers minus the cost to sellers. And of course, total surplus then is the value to buyers minus the amount paid by buyers plus the amount received by sellers. Well, we know these two are the same thing in our regular market because the price paid is the price sold. These two cancel out, and the total surplus is just the value to buyers minus the cost to sellers. Nothing really much new here. I'm just, it's just showing you the breakdown of total surplus into consumer and producer surplus. And, the sum of these two things is just the total surplus. And that's just the difference between the value to buyers and the cost to sellers. So again, this is, I've already I have a couple slides that I kind of already talked about it, but it's good to just go over them to reinforce it. So again, we have our market. This is consumer surplus. This is producer surplus. And so, the question is, I already asked this, but let's just go over it again to reinforce it. Is this equilibrium price and quantity the best we can do? Does it maximize total surplus? And I went through why it doesn't, but let's go through another example. This, gives it hits it at a bit of a different angle. And so the answer is yes. And so we can look at this segment EB, okay? And so if you look at this segment, these are consumers who value the good less than the equilibrium price, right? This point here, all these points here are prices below the equilibrium, okay? So they all value it less than the equilibrium, okay? And so these people will not buy the good, right? So consumers who value it less than the price won't buy. Now let's look at this segment ED. These are all producers with costs higher than the equilibrium price, and so they won't produce. And so, well, that's exactly what we want, because if you look here, surplus is equal to the value to buyers minus the cost to sellers, as we just saw. Well, in this area, we would have it would be negative. The value, the surplus would be negative. You wouldn't want these transactions to occur because the value of the good to the consumer would be less than what it would cost to make it. But in command economies, especially if you read some of the examples in the first slide, if their central plan dictated that the quantity should be over here, then they did whatever it took to make that quantity very high. And it could be inefficient, but they didn't care. In a market, there's a natural tendency to not do that. So again, you could just think of, about these being a marginal benefit and a marginal cost curve. If you can do any activity and on the margin, the marginal benefit exceeds the marginal cost, then you should keep doing it, right? That's the idea. And so when that's not true, then you would stop. So and again, this is just in theory. Of course, in the real world, there are all kinds of complications to this and things that are not in this model. There's implicit assumptions here, but you can't really argue. The only economic system that has yielded any reasonable standard of living that I know about anyways is a market system. There's hybrids, there's not any pure market systems, but if you have, a good portion of your economy set up somewhat in a market system, you tend to see much higher standard of living, but you do see a little more inequality, and there are some other issues, but China is the best example. In the 1980s, but in 1980s, roughly 90% of their population lived in abject poverty. Now it's less than 0.5%. And that exactly coincides. So up till around 1980, they had a socialist system where they have the command system, like we talked about, a very strict, system like that. And then in the 1980s, they slowly started to transition into a more market-based economy. And, you have this unprecedented in human history change in the amount of people who, they lifted more people out of poverty probably than any time in human history. So, and you just see, if you look at any countries that followed the command system, they were very poor. There was lots of poverty. So, it's not that surprising, but, it's not as perfect and easy as this in theory in the classroom, right? But the fundamentals are there, right? And the biggest thing is that there's perfectly aligned incentives. Like the incentives are aligned with efficiency and productivity and that sort of thing. So anyway, so the bottom line, given this theory, would be that free markets allocate the supply of goods and services produced using our scarce resources to buyers who value them the most highly, as measured by their willingness to pay. And free markets allocate the demand for these goods to the sellers who can produce them at the lowest cost. That's simply what the demand curve and supply curve is telling us. So really a benevolent social planner cannot really do any better than this. So they couldn't change the allocation of consumption among buyers or the allocation of production among sellers to make any improvements. And so again, what's interesting is this is costless. If you just set up a market, you have the bare minimum that you need to have a functioning market, like private property rights and stuff like that, you can get an efficient outcome. Nevertheless, there are issues with the market economy that we did talk about, like inequality. Public goods won't get produced, but you get the big picture. And again, if you look at any quantities to the left of the equilibrium, the value to buyers is greater than the cost to sellers. And so you want to produce these, right? And then anything to the right, the cost to sellers is greater than the value to buyers. So you wouldn't want to produce those units. So that's the bottom line. That's all you need to know for this. Now we're going to think about if we meddle in the market. So remember we talked about price floors. So here, what in this context, what would be the effect? So in our diagram here, we have that the equilibrium price is P0 and Q0. And then suppose the government says that we don't want the price to go below P1. So first of all, what's that going to cause again? A shortage or surplus. So this is a price floor above the equilibrium. Anyone want to give it a try?
Surplus?
Yep, exactly. So we'd have a surplus. Okay. Now, let's look at the quantity. So what quantity here would be exchanged? So just think about it. We have, if the price is forced to be P1, the quantity demanded will be Q1, and the quantity supplied will be over here. Pretend there's a Q2 here or something. What would actually be exchanged though? So think of you're at the farmer's market and there's a set price. All of the vendors selling green peppers are selling them for $2. But at $2, and so that at that price of $2, it's attracted a lot of different farmers there, and they're all selling their green peppers, trying to get $2. But at a price of $2, the quantity that people want to buy, that would be something like Q1. So let's say this farmers market's management or something got together and they got all the farmers to agree that they're not going to let the price of green peppers go below $2. Okay, so then now we're at the market. We got all these farmers with green peppers. They're all putting $2 price tags on them. And the consumers, their demand curve is represented by this. They're only going to want to buy Q1. But at this price P1 that they've set, there's going to be a lot of green peppers there, Q2. So there's Q2 green peppers, but only, the consumers only want to buy Q1. So how much will get exchanged? Would it be Q2? No, because no one wants to buy this surplus. That's why it's a surplus. So Q1 would actually be what would be exchanged in the market, right? Does that make sense? So people, that's what people want to buy. If the price is stuck at $2, that's what people will buy. And when they buy it, that's an exchange. The Q2, that'll be a surplus and it'll go unsold, right? And so we're saying with a price floor too, like in order to keep the price from falling, obviously the farmers are going to realize $2 is too high and they're stuck with all these green peppers still. So there's going to be people are going to, even if some people might sneak around the agreement they had and try and sell theirs a bit lower of a price, or they might do 2-for-1, or I don't know. There's going to be a tendency for the price to fall. If the government or the managers of that farmers market really wanted to keep it at P1, someone would have to buy this surplus, right? Or the government could, or they could say you'll be kicked out of the farmers market if you don't abide by the rule or something like that. But still, there'd be really strong tendency. So anyways, the whole point here is that when you have a price floor, the quantity exchange is going to be here, and it's going to be lower than the equilibrium. And so guess what? You have this whole area here, this surplus won't be realized because you're only going to produce Q1. And so only this triangle up to Q, well, it's not a triangle, it's, this area, then this, this whole thing right here will be the total surplus. But if you just left the market alone, the total surplus would be this entire area. And so a binding price floor will tend to cause what's called a deadweight loss. That's just referring to this area here, these mutually beneficial transactions that won't occur anymore. Another example I like to bring up reminds me of when I was an undergraduate student. So I lived in Guelph and I did my master's at Guelph, and you would go out to the bar on a Sunday. This is before Uber. If you went out to the bar on a Friday or Saturday night and you needed to get a taxi at 2 in the morning when the bar is let out, good luck. You're not going to be, usually it would take a very long time to get one. And that's because the city municipal government has a quantity limit on the rides, right? They only give so many licenses for taxis. So there's just not enough taxis at that particular time. So you could think of the demand and supply curve in the evening. And then you would want to think of the supply curve as being anyone in the city that would be, if they were allowed to, would be able to offer rides around the city. Well, but they can't because of this government regulation. So say the amount of cabs is at Q1 and it's forced to be there. It's not because of a price floor, but it's just forced to be at Q1. So you could think of just a solid line here. Well, that there are people in the city that would happily drive someone home for $25. It would cost them what, $2-3 in gas, and they'd make a nice little profit. But you can't do that because of the government having this forced licensing system. And so they're basically, forcing the queue to be below what it would be if you just had a free market and anyone could drive. And that's so you can think of Uber as coming in and sort of making things go more towards a market outcome, which is a positive thing, I think. Same with like Airbnb, if I have an extra room in my house and I want to rent it out for someone, why can't I? It's a mutually beneficial transaction, right? If I if I can provide it at a lower cost, including my opportunity cost of, dealing with that, and someone's willing to pay for it, there's a mutually beneficial trade. But when you have the government restricting the queue, below where the market wants to go, you have a deadweight loss. All we're basically saying here is that there are mutually beneficial or voluntary trades that are beneficial to both parties that you're restricting, and they won't occur. And, our wealth, our income as an economy as a whole is based on the total quantity of goods and services we sell in a year. And, we'll learn more about that in macro. So anyways, that's the idea. So in this case, we're just talking about a price floor. The price floor will cause the quantity to be lower at Q1. Only these amount of goods are going to be exchanged because, it's only going to be the minimum of either the quantity supplied or quantity demanded, right? If that's how many people want it, then, and the supply is much larger, well, only the amount of, the total amount that's produced, only a fraction of it's going to be bought by the consumers. If, in this situation where you have a surplus. So that's the idea. Does that make sense? I mean, you guys are really quiet. Just say yes or no.
Yes, this does make sense.
Okay, good. Thanks, Tom. Now,
no problem.
Yeah, it's just, I just want to make sure I'm making sense. So now with a price ceiling, if you remember a price ceiling, think of a ball bouncing it, the price can't go above this ceiling here. So the government, for whatever reason, maybe like rent controls, the best example is thinking of the rents in Toronto, how ridiculously high they are. Maybe you could think of the government thinking that, well, let's just solve the problem by putting a price ceiling. So now, they make rent, they make a law that rent can't be above, say, $1,000 a month or something like that. And if that is below the equilibrium, then it's binding. We have a price ceiling. And so what's going to happen now? So what situation do we get into here? Is this a surplus or a shortage?
Shortage.
Yeah. So a binding price ceiling will lead to a shortage. And so in this case, what is the amount of goods that are going to be exchanged here? Suppose that here there's a Q1 and this is Q2. I don't know why they did it like this, but whatever, there's definitely a difference between the quantity demanded and the quantity supplied. So again, it's going to be the minimum of the two figures here because this is how much is going to be offered for sale. It doesn't matter if the quantity demanded is much larger. This is all that's going to be available for sale. So this will be the only amount that will be exchanged, right? So again, we have a situation where if we just left this market alone, we would have Q0. And so this whole thing would be the surplus. But at Q2, well, Q2 will be the outcome of this price ceiling. And so we're missing out on these mutually beneficial transactions, okay? So that's, the sort of there's other things, lots of different things you can do. You can analyze the effects of a tax. So a tax will also cause a deadweight loss. We'll see later on so right now we're talking about a competitive market. We'll get into that shortly, but we don't really say it explicitly. None of the textbooks really do, but up to this point, we're making an implicit assumption that we have competitive markets, meaning that there's lots of consumers. So no consumers can sort of get together and, manipulate the price. And we have just tons of different firms. And so each firm is very small. They can't really organize together and restrict the supply or do anything like that. That's the idea. But, obviously there are different market structures. So if we had a monopoly, we'll see that if everything else is the same, except that the industry is a monopoly, characterized by a monopoly rather than a perfectly competitive environment, we will see that we'll also have a deadweight loss. The actual quantity that would get produced would be much lower and the price would be much higher. So there's all kinds of different things you can analyze with this simple model, and it gives you a good, idea of the effects of certain policies. Of course, there's lots, it's not as perfect like this in the real world. Try actually estimating a demand curve. It's not all that easy. It's really hard to actually do that because if you just have a bunch of price and quantity data, how do you know what the change in the price was caused by? Is it supply or demand? You really have to have a lot of information to be able to tease out what exactly the demand curve, changes in the price. Are they just a movement along the curve, or is it because of a shift? There's lots of it's very complex to actually estimate something like this in the real world with data. And sometimes it's very hard to do at all. But anyways, it can be done, and it's, done a lot. Anyway, so that's the main gist of that chapter. Now we're going to go on to production and costs. So in this chapter, we're just learning about some of the, basic patterns that you would see in the short run. We'll talk about that in a moment in terms of production costs. We'll first just talk about what we mean by costs in economics. So we're going to look at the difference between economic and accounting profit. So economists use, well, it depends on what the context is. If the context calls for something like accounting profit, then we'll use it. But for when we're looking at efficiency in markets, and for the most part, we always really think about economic profits rather than accounting profits. So what's the difference? Well, basically the difference is that, so when you think of what an accountant would do to calculate the profit of a business, in general, they're just taking the revenue or sales and subtracting the costs that were incurred to generate that revenue. So if you have a sandwich shop, your profit is going to be whatever's left over. You get all these sales from the sandwiches, and then whatever's left over after you pay for people to make the sandwiches, the ingredients, your rent, insurance, all of those explicit costs, whatever's left over is your profit. Economists would just go one step further and also subtract off implicit costs. Like I said earlier, the opportunity cost of the business owner's time, or what else they could have done. So that's the main difference. And then depreciation is also considered an explicit cost. Explicit costs are generally things you pay for, but depreciation, there's not really an outlay for that. It's sort of it's a write-off. Well, you've already paid for the capital. You've already outlaid the money. If you own a business and you buy a truck for your business, well, you outlaid cash to buy the truck, but every year, but you can't expense that all at once, right? You can't just take that expense on the truck and write that off against your sales all at once. You're supposed to just slowly expense that off through depreciation. And I'm not an accountant, but that's the main idea. So we just go one step further and subtract off implicit costs as well as explicit costs. So accounting profits would just be revenues minus explicit costs, and economic profit would be accounting profits minus implicit costs. And again, implicit costs are, there's something that accountants would ignore. And of course, you wouldn't pay tax. The government also ignores them too when they're thinking of how much taxes you have to pay on your profit. They don't want to tax you on accounting profit, which is always going to be lower, right? Because you're subtracting off something else. So, in general, these are the opportunity costs for the firm that we like to include as economists. Two of the key things or implicit costs that come to mind are the opportunity costs of the owner's time and the opportunity costs of the owner's capital, right? If they could have borrowed the money, or they could have had it saved. If you saved up $10,000 and you put that into a business, well, the opportunity cost is whatever else you could have done with that $10,000. So you could have invested it in the stock market, and in the long run, you typically get a 7% per year return. So we would subtract that off as well. And if economic profits are negative, we call them economic losses, obviously. So this is just a hypothetical example. So suppose we have some business, they sold $20,000 worth of goods or services. They had to pay rent, they had to buy materials and supplies, they had to pay the electricity, they had to hire some labor, and their depreciation was $500. So their total explicit costs here are $17,200. And so an accountant would say that this business has a profit of $2,000 and $2,800. Now, if the owner of this business's opportunity costs were $800 that year, and if you were to value the labor put in by the owner, so suppose they could have got $4,000 elsewhere for their labor, well, then we want to subtract that off as well. And so after so we're basically think of the idea of whether it's a good idea for you to open a business or not. Suppose that you're a lawyer and you're making $200,000 per year and you get this bright idea to open up a sandwich shop. Well, if you open up the sandwich shop and you make $100,000 accounting profit, well, economists would say, well, you're not actually making any profit. You're actually losing 100,000 because we would subtract off the 200,000 they could have got working as a lawyer. So although they made $100,000 accounting profit, they gave up 200,000 to make that. So they really lost $100,000. And so that wouldn't be a good allocation of labor, right? That's why accountants think that way. So here, then the implicit costs are 4,800. And so really the economic profit here was not even profit, it was actually a loss of 2,000. Okay, so there's some terms here. Normal profit, just in my example with the accountant, the normal profit there would have been 200,000. Because so if that business sandwich business made $200,000 in profit, that would be exactly equal to what they could have got elsewhere. And so if you make a normal profit, we're saying it's just enough to keep you doing what you're doing. And so if the sandwich shop made $250,000, then we would say we would have, there'd be positive economic profit of $50,000. So it was a good idea for this person to quit. For whatever reason, their value in terms of making sandwiches, their value to society is much higher than if they were continuing as a lawyer. So normal profit is just the minimum profit that must be earned to keep the entrepreneur in that type of business. Economic profit would be anything above that. A sunk cost, we don't really get into it that much, but a sunk cost is something where you've spent the money and you can't get it back. And so you shouldn't, you shouldn't account for that when you're making decisions. In general, you could think of it, a good example of a sunk cost would be if you go to the movie, suppose you go to the movies, you spend $20, you can't get the money back, maybe there's a no refund policy. You go into the movie and you realize after about 10 minutes, the movie's terrible, you're sure it's not going to improve. What should you do? Should you stay to the end and get your money's worth? What do you guys think?
I already spent the money, so I might as well stay.
So you might as well stay and watch it?
Yeah, the money's already spent.
Well, what are you giving up if you stay in the theater to the end?
You're giving up your own personal time, and your own time is worth value.
Yeah, exactly. So if you have absolutely nothing else to do and you're getting a tiny bit of pleasure from the movie, then you would probably want to stay. But if perhaps though you could just be you would enjoy the ride home and watching TV better, you would actually get more pleasure from that, then you should leave. For the most, but if you're assuming you're not getting any pleasure from that movie at all, then you should probably leave. That's sort of the idea. But also if if you're a business and you have to you've paid the rent for the rest of the month, that's a sunk cost. You're never going to get that back. So in terms of whether you should make more sandwiches or not in your business, if it's a sandwich business or things like that, you're thinking on the margin if you should produce more. That shouldn't come into play because it's a sunk cost. It doesn't matter anymore. I'm not sure if we'll spend too much time on that concept anyways. That's just kind of in here. Okay, so let's just do an active learning question here just to drive home this concept. So Rodriguez operates a variety store with an annual revenue of $480,000. Each year, he pays $25,000 in rent for the store, $15,000 in business taxes, and $350,000 on products to sell. So not a very high margin business here. He estimates he could put the $80,000 he invested in the store into his friend's restaurant business instead, and he's pretty confident he could get a 20% profit on his funds, which would be pretty good. He also estimates that he and his family could earn, so his whole family, I guess, is in this business. They could earn a total annual wage of $90,000 if they worked somewhere other than the store. That would be their next best alternative. So in this case, what are the total explicit costs? Anyone?
The explicit cost would be rent that he has to pay and business taxes on the money that he's earned. But that's a variable, right? So just I think the explicit cost would just be the 25,000.
Oh, but so implicit cost can be variable and fixed.
Okay. So then with that being said, it'd be include your 25,000 that he's going to pay for his rent, and he's going to got 15,000 for his taxes on his business revenue taxes. That's all I see.
The 350,000? So he had to pay that to buy the products, right? He's selling, right?
Oh, okay.
So,
I'm sorry, I read the okay. Yep, and there's 350. So yeah.
Yep. So exactly. So these three things would be the explicit cost, and then implicit costs. So how much is he giving up in terms of this investment in just 1 year?
Well, he's making 90,000 a year, and he's going to have 80 out of that 90. Is that what you mean?
Oh, no. So there's two implicit costs here. So the first one is related to the money that he's put into this business. So he had so I guess he had $80,000 saved right in the bank, and he's put that money into the store, probably to buy, we could assume he would to buy some of the products or something like that. So by putting this $80,000 in, what did he give up for 1 year? He gave up 20% profit that he could have got in his friend's restaurant business. So one of the implicit costs then would be 20% of 80,000. And then what would the other implicit cost be?
The 90,000 if his family works somewhere else.
Exactly. Yep. And so basically, yeah, that's how we'll show the calculation in a sec. Okay, so yeah, we have all the information we need. So the total explicit costs, are 390,000. That's the sum of those three things you mentioned. And then the implicit costs would include 20% of the 80,000. That's just what he gave up for 1 year. He could have got apparently 20% return on his 80,000 instead of when he put it, instead of putting that into his business. And then the other implicit cost was the 90,000. So the total implicit costs are 106,000. And so the accounting profit would be the total sales, right? 480,000 minus that 390,000, which is the sum of these three things. And so it would be 90,000. The store's economic profit, which is found by subtracting off not only the explicit, but also the implicit, would then be negative 16,000. So we're just going to take that 90,000 now and subtract off 106,000, and we're left with negative 16,000. So in this case, since it's an economic loss, this person could do better elsewhere according to this. Okay, so when we talk about a firm's profit, we're always talking about economic profit in this course because we want to include those implicit costs as well. So in general, profit, so in economics, we just use this pi symbol. It's just a short form. Instead of writing out the word profit, we just put this there. And so profit is generally just total revenue minus total costs. But this includes both definitions of costs. And that's pretty simple to remember. Like in general, what's the profit of a business? Well, it's the difference between how much it gets in revenue, what it sells, that dollar amount, and then you're subtracting off the costs. And so that difference is what you get for profit. We would be assuming that would include taxes as well. So so now we're going to look at just some general patterns in terms of production and costs in the short run. The short run is simply just a time period where one or some of your inputs are fixed. The easiest way to look at this is thinking of capital and labor. So most businesses, they have, like a restaurant, you have labor and then you have capital. Those are the two biggest inputs. Of course, there's the other inputs like the stuff to make the food and everything. Let's just abstract from that just to keep things simple to get the main idea. And so we'll assume we're just, for the most part here, just looking at capital and labor. And so capital, we're going to say, is fixed in the short run. So if you think of a restaurant, it has an oven. There's the capital, like the size of the restaurant, the size of the building. That's part of capital. In the short run, we're saying the short run is the period in which that would be fixed, right? And so if you have fixed capital like that, and your other input, like labor, is variable, you can increase production only by increasing your labor. But if you have your capital fixed, what's going to happen is eventually, you'll hire labor and you'll get more output, but at some point, whenever you hire labor, you're going to get less and less and less out of that labor, and then you could even get negative because people would be over each other because the size of your space is fixed. So that's the context we're thinking of. So again, the short run, it just means that there's one input fixed. We're typically going to think of capital as being fixed. And yeah, these could be anything from, the fixed that we're going to think is capital, could be land management, supply of skilled labor, all kinds of things. So usually when you have one of them being fixed, there's some sort of a barrier there, right? And in the long run, would be a time period where you're able to just increase all of your inputs to whatever you want. So in the long run, a restaurant can choose any size it wants for its kitchen and number of ovens or whatever, right? No, it's not. It's just an abstract sort of concept, not referring to a specific length of time. It's just, an abstract idea of, when you have a period of time where you would have an input being fixed. Okay. So as I said, the long run would be where, in the long run, if you're thinking of like a planning horizon, you plan for any number of inputs. Okay. So all of the firm's factors of production and technology can be there. So we're just going to focus on the short run. And so we just made an assumption. We said we're going to be looking at what the general pattern of production would look like if we have one of our inputs being fixed. And so we're just going to define some different here. So we're first just going to look at production. Okay, so we're just going to look at total product. So total product is just the total amount produced during a given time period. So if we're talking about the total number of large pizzas from a pizzeria over a month, the total product, just how many pizzas were made in a month. The average product would be taking the total product divided by the number of units of the variable factor used to produce it. So we'll just keep things simple and just assume that the only variable factor would be labor. Okay, so if in a day we made 100 pizzas at the restaurant and we had 10 people, then the average product would equal 10, 100 divided by 10. So we're saying on average, each worker made 10 pizzas. Now we know that it's an average, it's not going to be exact, because if we hire, if we hire the first worker, if we just had one worker running the pizzeria, they're not going to get too many pizzas, right? They'll have some. But if we hire a second worker, then they can each specialize in a task. We can get even more pizzas than just from the first worker. So you can think of, on the margin, the amount of output will increase at first because there's, areas for specialization of tasks. And then, at some point it's going to fall. We'll talk about that in a sec. But this average product is, we're just taking, okay, we made how many pizzas, how many workers, divide, and that's just on average how much each person produced. So that's average product. And so average product, again, is just total product. We'll also sometimes, I'll use the word Q for this interchangeably. So Q would be equal to total product. And so that's total product, and then you just divide that by labor. That's average product. Marginal product is, so this depends on the level you're at, right? So marginal product is the change in your total output or total product or Q that results from using one more unit of a variable factor. Okay, so again, if you have a pizzeria and you hire the first worker, you're going to be able to get a certain number of pizzas out of them. But if you hire another worker, you're going to be able to get even more pizzas than that first worker would be able to produce in most cases because of specialization. And so the marginal product of the second worker will be higher than the marginal product of the first worker. And then you could think of a third worker. Well, now you can have two tasks specialized in the kitchen and one person serving in the dining room. So you probably get an even larger increase in marginal product. But at some point, that specialization will be exhausted. And then when you hire another worker, you're going to get less out of them than the worker before. So anyways, marginal product is just talking about how much extra do you get when you hire an extra unit of labor. That's the idea. Does that make sense? And so we just define that as the change in output. So this is just meaning change, this triangle. So this is the change in total product with respect to a change in labor. Okay, so when we calculate this, this gives us just, if we hire one more unit of worker, how much extra output are we going to get from that worker? That's all this is talking about. So let's look at a numerical example. So it looks like there's a lot going on here, but it's not too bad. All we're given, we can derive everything here just from these first two columns. And all these first two columns is, the first column is very simple. It's just the number of people we're hiring, 0, 1, 2, up to 13. And this just tells us how much output we would get for each unit of labor. So if we don't hire any labor, well, obviously we can't make anything. So it would be 0. If we hire one person, we'll be able to get 3 units of output. If we hire 2 people, we'll be able to get 7, 3, 13, etc. Now, the average product, as we said, is simply just taking this and dividing it by that. So if we hire one worker and they make 3 units of output, well, on average, each worker made 3 units. Well, there's only one worker, right? If we hire 2 workers and we got an output of 7, well, for each of them on average made 3.5. Just 7 divided by 2, and so on. We made, if we hired 13 workers and we got an output of 120, then on average, each would make 9.2. Now, marginal product is where it's a little more interesting. So when we hire the first worker, the marginal product is 3, okay? And so it's actually the same as the average product. Now, I kind of don't like how they've put this here. I'm just going to see if I can, I'm just going to update this graph for a sec. All right, I like so that these are lined up. So when we hire the first, oops, let me put it on full screen. So if we hire the first worker, the average product is 3, and so is the marginal product. What's the marginal product of the second worker? Anyone? How much does that second worker contribute to total product or total output? That's really what marginal product is. That's another way of saying it as well. How much does that additional worker contribute to the overall output? So what's the marginal product without looking of the second worker?
3.
Okay, so let's look. So
Second, 4, sorry.
Yeah. That's,
Second work, okay, 4.
Yeah, so if we have one worker, we're going to be able to make 3. We hire that second worker, we're going to get 7. So we're just looking at the difference here. And so the formula is actually the change in total product. So the change here is 4, and then we divide that by the change in labor. Well, that's only 1, right? So this question could easily have 0, 10, 20, 30, and so we'd have to divide this change by 10. But this is easy, so here we just go up by 1. So really in this, because we only go up by 1 always here, the marginal product is just the difference between these two numbers. So the marginal product of the third worker would be how much?
6.
6.
Yep, exactly. So that would be 6, and so on. So, okay, that's,
Just a quick question, because when you look at the average product, AP equals T over L, if you got three people making 3 pizzas all at the same time, it doesn't make sense. And I know it's how it actually is, but I can't grasp it. We got one person making 3, we got 3 people making 9, right?
Oh, so, no. So this is saying here, just think of one person working, and at the end of the day, they are able to make 3 units, okay? And so the average product of that worker is 3. It's just because there's only one worker, they made 3, then the average product is just 3. Like there's only one person, right?
Yeah.
And then for the second one, it makes a little more sense, right? Because now you have 2 workers, and at the end of the day, they made 7. So then we're just saying they made 3.5 each. That's the average product. On average, each made 3.5 pizzas or whatever it is.
But where is the total product, numbers coming from? Are they just
it's just a hypothetical example.
Okay. I was banging my head against the wall here going, the math is not adding up.
No, we're just, this is just a hypothetical example. We're saying there's some, suppose that a business is such that if they hire one worker, they get 3. If they hire 2, they get 7, right? It's just a hypothetical.
Okay.
Yeah. We're not saying this So economics is always what if, not what is. A lot of the time, yeah, that's the economics is a bit strange because it's very abstract, but yeah, we're just saying, suppose it's like this, but this is constructed in a way that we think it will sort of look like given our assumptions of fixed capital. We'll talk about that in a sec. So that's how you calculate these two measures, and then here we're just going to plot them. So if we plotted the first two columns, we would get something that looks like this. So again, we're just plotting. And so at 1, we have 3. So at 1, we have 3. That's right there. 2, we have 7. 2, we have 7. And, if we had up 12 workers, we would have 119. So that would be up, this point here. So, but we can, when you see it in a diagram, you get a lot of more, you can glean a lot more information from it, right? So you can see here from 0 up to 6, this is increasing at an increasing rate. This is sharply increasing, okay? Then all of a sudden, it's still increasing, but you can see it slowing down. So this is increasing at a decreasing rate. And then at some point, it would likely hit a maximum. So if we look at the marginal product, we can see here that this is increasing up to a certain point. So, and this makes sense in most, businesses that you could think of because of like what I'm saying with specialization. If you think of what's even any sort of thing where you're producing something, right? If you just have one worker, you're not going to get that much output out of them. Think of the restaurant example. You have one employee in the restaurant all day. They got to work in the kitchen and in the dining room. Not very efficient. So their output's going to be very low. If you hire a second person, you could have specialization. You can have one person in the kitchen and one person cooking. So when you hire another unit of labor, you're not just going to get the same output as before. You're going to get more, and up to a certain point though, because we're in the short run and capital is fixed. So generally, if you assume that some input is fixed, but another one you can vary, for the most part, you would see a pattern that looks like this. First, let's look at the marginal product, okay? So this is a graph of the marginal product here. It increases and then falls. So this is just this thing here. So this is the pattern I'm talking about. So you would think at first you would be able to get some gains from specialization of tasks and that sort of thing. So each time we're hiring a worker at first, we get more and more output from that extra worker, right? But when this starts to fall, we call that point the point of diminishing marginal product. And this is simply a consequence of the fact that one of the other inputs is fixed. In the case of a restaurant, the size of the restaurant's fixed. So you're going to be increasing, you'll get some gains from specialization, but that's going to run out eventually. You're not going to gain much output if you have 2 people putting the pizzas in the oven instead of 1, right? So, there's going to be a point where the additional benefit from hiring another worker is going to be lower than before. And you could even think this could be negative, right? If you have too many people, they could be tripping over each other and actually making things worse and causing less output to be produced because they're causing inefficiencies. Just too many people. And this is all because capital we're assuming is fixed. If you could increase the size of your kitchen, well, then diminishing returns isn't an issue anymore. That's the long run. So this is just a general pattern. So this is just called the law of diminishing returns or something, just our point of diminishing marginal product. Now, if we look at this graph up here, we can see that the maximum corresponds to this point here where, it's increasing at an increasing rate and then it's decreasing at a decreasing rate. In math, this is actually called an inflection point. We'll mostly be working with these graphs, so won't have to use this one too much, but you get the idea. So, I'll just point out some things here. So at the inflection point, that's where we have our maximum marginal product. Now, it's worth just taking a look at the average and marginal product, so the relationship between the two. So if on the margin the marginal product is increasing. So every time we hire a worker, we're getting more and more output. Then of course the average product, which is just saying, on average, how much did each worker make? That's obviously going to be increasing if this is above it, right? It's just like if you had a box and if you throw numbers into a box, and then on the front of the box, it shows you the current average of all the numbers you've put in it so far. So say the average is 10 right now in the front of the box. Well, if you throw a number in there higher than 10, the average will increase, right? If you throw a number in below 10, the average will fall. So here, it's like we're throwing numbers in the box that are all higher, right? And so that's why the average product is always increasing. Here they're equal, and then now we're putting in numbers into the box that are all lower, and so the average product is falling. And so anyways, you're going to see that the maximum point on average product is right here, and they're both going to, basically the marginal product curve comes up and hits the average product curve at its maximum. That's the main thing you need to know about the relationship between these two for this course. Yeah. So anyways, that's just the general pattern of production you would tend to see when you have a fixed input like capital and varying labor. It could be, the point of diminishing marginal product might not happen too much different, but you'll get the same overall general pattern. Like the numbers are all could be quite different. You could have marginal product, maybe after the second unit start to happen. Depends on whatever production process you're talking about. But you should see, the main thing in theory, you would likely see is, so at some point you're going to have diminishing marginal product because you have one of your other inputs fixed. That's the main idea. So that's the basics of the production in the short run. So this law of diminishing returns, as I said, is just the idea that at some point you'll hire another worker, or you'll increase the whatever variable input it is, and at some point you're going to get less out of the additional worker than you did the worker before. And again, that happened here at what unit did that happen? So when did we see diminishing returns start to take effect here? We saw it start to happen after what worker? What number of workers?
The midpoint. 8.
Yeah, or you could say after the 7th worker.
Yeah.
So 7th worker, we had 25. Then when we hired that 8th person, whoa, we got only 18 extra units out of that person. But the person before, we got 25. So all these here, we're getting higher marginal product. Then all of a sudden, we can hire another worker, but we are not getting as much as before. This could be the capital. We only have so big of a restaurant or whatever, right? Now, actually, just as a prelude into the costs, which we'll learn in a second, if you were paying labor $10 an hour, so you always pay $10 an hour for labor, think about the cost per unit. So if you hire someone, pay them $10, and you get 3 units of output, and you hire another person and you get an extra 4, and then you hire another person, still paying that person, each person or each hour is paid $10, right? But you're getting more and more output. What would happen to the marginal cost, or the cost per unit?
Decrease.
Yeah, it would decrease because you're always paying a fixed rate for labor. But if you're getting more output, the cost per unit is going to be lower, right? Your number on your denominator is getting larger, but the cost is staying the same each time. You could think of, so here you hired one worker, you paid them $10, and so your cost per unit is what? So you paid $10 to get 3 units of output. So it would be 10 divided by 3, right? And then if you hire the second worker, you still paid. So the increase now would be from 10 to 20. So your costs are going to be 20, but on the denominator, you're going to be adding, if you added 3 again, then your cost would stay the same, but you're adding 4 to your quantity. And so it's going to be even lower, right? We'll get into that in a sec. But you can see that if the marginal product is increasing, your marginal cost will be falling. But now if you're hiring someone and still paying them $10, but you're getting less and less out of them, well, then your marginal cost will be increasing. So we'll talk about that in a sec. I just wanted to bring it up first to think about, and then we'll get into it. So anyways, the law of diminishing returns is just saying, because we have one of our inputs fixed, at some point when we add another unit of labor, we're going to get less output at some point. So eventually equal increases in work effort begin to add less and less to total output because one of the inputs, like capital, is fixed. This is another numerical example. So here, what would be so what's the marginal product of the first unit of labor?
Just the first unit of labor is 0.
Or sorry, going from 0 to 1. When we hire that first person?
4.
Yeah, so that'll be 4. What about the second worker? How much extra output? Like, how much is the second worker contributing to total product?
8 more.
Yeah, or 12. So 16 minus 4, right? So when we hire the second guy, we have a total now of 16. So we go, the first one contributed 4, and we're saying now when we have a second one, they contribute the difference. This is the total, right? So we're at 16 from 4, so the difference is 12. So marginal product, again, is just the change in this divided by the change in this. The change here is always 1, so it's just really the change in total product. Does that make sense? Yeah, yes, no? Anyone there?
Yes.
Yeah.
Okay, good. So here, where do we see diminishing returns start to take effect? After which worker?
Number 6.
After the 4th.
Yeah, so it's after the 4th, right? So when we hire the 4th worker, we get 24 extra units, 60 compared to 36, and so that's 24. But now when we hire this 5th person, our output only increases by 15. So all here it's increasing, and then boom, right here, it's starting to fall. That's where diminishing return starts to take effect. And in this numerical example, we're saying that if we hire the 8th worker, we'll actually reduce our output. So this person's going to be tripping over other people. There's too many, you got too much labor with a fixed capital, right? Too many people in the restaurant.
Too many cooks in the kitchen.
That's even better. Yeah, even better. Yeah, too many cooks in the kitchen there. So don't confuse. This isn't diminishing returns, though. This is diminishing returns. This is negative returns, the different concept. Yeah, and so average product, how do we calculate that again?
Total product over labor.
Yep, so that's going to be 4 for the first one. And, the second worker here, we get 16 units, 16 in total, but 2 workers made the 16, so we're just saying each on average makes 12. Here, 36 divided by 3 is 20. Or sorry, my mistake. Yeah, that's the full table. Sorry about that. 16 divided by 2 is 8, not 12. Yeah. And here's 36. 36 divided by 3 is 12. This is your average product. And if we were to graph this thing, it would look similar to what we had before. Right? This is the different numerical example, but same pattern, right? That's the inflection point, which corresponds to the maximum of the marginal product. When marginal product is above average product, it's again like throwing numbers into the box greater than 10. They're going to make 10 higher, the average increase. So whenever this is above, this is obviously going to be increasing. And then here you're putting in numbers into the box lower, so that's going to drag down the average product. So we call this point here the point of maximum productivity because this is where, this is the maximum average product. So average product is how much, output per worker, right? That's a general measure of productivity is how much, output per worker. So that's actually what productivity is. So it's actually output per worker per subunit of time, right? That's implicit here. So this could be for a year, a week, or whatever. So anyways, yeah, that point is the maximum productivity. These points, so when the marginal product hits its maximum, afterwards it starts to fall. That we say that's the point of diminishing return. In this case, this is a little off here. This looks like it should be around here. This should be the peak, right? That's the point of maximum total product. And that's actually obvious. So if your marginal product starts to become negative, well, then this must be the maximum, right? If it was always positive before, because all of a sudden now you're subtracting from the maximum.
Hey, Jason, is there any way you can make your mouse like bigger, or because there's a lot of times you're trying to point stuff out on the screen, you can't even see your mouse because what blends into the background.
Yeah,
either bigger or darker or something.
There's a laser pointer here. Oh, yeah, then I gotta use the space bar. Yeah, that's fine. Okay. So I've already sort of brought this up. Again, this is what I'm talking about my box and adding the numbers. So, I'll just, you just review that when studying. I already talked about it. This is just, you have it written in words, what's going on with the relationship between marginal product and average product. Okay, so now we're going to switch over to costs. And so the idea is kind of simple, like just in general. I brought this up earlier. You just think of if you own a business and you're paying a fixed rate per hour for labor, and if each time you hire a unit of labor, you're getting more output than the person before, then your cost per unit must be falling, right? Because you're not paying more for labor each time. You're paying the same amount, but it happens to be giving you more and more. And your cost per unit is simply just your cost divided by, so you can think of C divided by Q. And so if Q increases more than your C, it's going to be falling, right? So basically what's driving all of this next stuff that you'll see is just the fact that, we're going to assume that the variable input has a certain price per unit, and, it doesn't, that price per unit stays the same. And so, we can derive all of our cost curves from that. So yeah, there's not too much to say here other than, we'll get into the costs. Usually we're not going to get into market structures yet or anything, but, we're just assuming that the firm doesn't have any impact on the price it would pay for inputs. That it's not always true. It's true if this firm is a very small buyer. If you're thinking of buying masks, these masks for the COVID, each company that buys them is a very small portion of all of the buyers, right? So they, you could think of them not having any influence over the price. So the price is just fixed at what they pay for it. And if they buy a lot, they're so small, it's not going to make a big deal. But if you think of something like a company like Walmart, they have a big influence over how much they pay for stuff, right? Because they're so big, they have market power and they can negotiate what if they want to sell strawberries, they can strong arm whoever, or I don't know, want to say strong arm, but they can get strawberries very cheap because of their size, right? They're a big buyer. We're assuming just a lot of small buyers. So we're just going to say they're paying the going market price for whatever input they're talking about, including labor. So any particular restaurant is just hires a small portion of the unskilled labor pool, or, if we're talking, it depends on what you're talking about, but so they're not going to have any influence over the minimum, the wage you would pay for unskilled labor. In fact, we would extract from a minimum wage, but because we're saying it would be just the market wage. Yeah, so there's a lot of different types of, different costs here. So we're going to talk about fixed costs, variable costs, and then basically their counterpart, their per unit counterparts. And then we're going to have a marginal cost as well. So actually this slide nicely summarizes all of them. So you've probably learned this before, there's two types of costs, fixed costs and variable costs. Fixed costs don't change with the output. If you own a sandwich restaurant, your fixed costs are going to be your rent, insurance, electricity, stuff like that. Well, electricity could be variable because the more you cook, the more you might have to pay for electricity. But things like insurance or your rent, anything else that doesn't vary with output. Variable costs vary with output. So these are things like obviously labor, your price of, how much you spend on bread to make your sandwiches, etc. So the total cost is just the sum of these two things. So we're just gonna, we're just going to use these acronyms. So TFC is total fixed cost, TVC is total variable cost. You add them together, you get total cost. Now we could divide each of these by Q, okay? If we do that, this still holds, but we're going to call this average total cost because we're dividing by Q. This is going to be average fixed cost, and this is going to be average variable cost. So that's what these are here. We're just taking these, dividing them by Q. And so we'll talk about these costs now. this is another slide. It's exactly what we just went over. It's another one I just put in so you have two slides. You know, when you're studying, it's nice to have things at a different angle. The only difference here is we bring up marginal cost. And marginal cost is, again, it's like, you know, it's a similar flavor as the marginal product, but it's different, right? But again, it's looking at, you know, it's looking at increments from being at a certain point. So here we're talking about what's the additional cost associated with making an extra unit of the good. So if I make another unit, what's that additional cost just for that extra unit? Okay, and this can be defined as the change in total variable cost divided by the change in quantity, or total cost. The reason why it could be either one is that the change in fixed cost is equal to 0. So it doesn't matter. You know, fixed costs are fixed. If you increase your output, your fixed costs don't change. So the change in your fixed cost with respect to a change in your output is always 0. So you can use the change in variable costs or the change in total cost, and we'll give you the same thing. So we'll do a numerical example. So this is the formula for marginal cost. Again, it's just the change in your total cost, and you can use total variable cost here or total cost. It doesn't matter because the change in total fixed cost will always be equal to 0. So either one, it doesn't matter. And you divide it by the change in quantity. In most cases, and here, most of the questions we do, though, won't have the change in quantity being equal to 1, like we had the change in labor being equal to 1. So it's, you know, you have to, it's not as easy just to calculate this by looking at the table. But anyways, that's the formula. And again, so marginal costs are always marginal variable costs because fixed costs do not change as output varies. Okay, so this is just another summary slide for you to have. And let's go into a numerical example. So this is from the production stuff that we learned. Okay, so we're going to start with the production stuff, and then we're going to look at total variable cost, marginal cost, and average variable cost in this one. Yeah, these are the main curves. Yeah, average fixed cost isn't all that interesting because it just always falls. So anyways, so here you'd be given, you know, you're given these numbers. So here, you know, this is a hypothetical example again. So we're told different units of labor. And actually, I think these are the same numbers as the example before. So here we're told that if you use 1 unit of labor, you'll produce 4, 2, you'll get 16. We can calculate our marginal product as we did before, just the difference in here divided by the difference here. These are always a difference of 1, so it's just the difference here. So there's our marginal product. Where does diminishing returns? Sorry, I don't know if you heard me there.
The midpoint. Yeah. So it's 4.
Yeah. So after 4 workers, we start to see it. Exactly. There's our average product. Now, total variable cost, we don't right now have enough information to get this, so we need to be given some more information, right? How do we know what the total variable cost is? So we're told now that 1 unit of labor is $120. So we can think of this as a daily wage rate. Okay, so then what's my total variable cost if I hire 3 workers? Anyone?
360.
Yep, exactly. Sorry, the space bar to move to the next slide is the same as the thing that that mutes the mic. So I have to click on the slide first. So sorry about that. So total variable cost now we can obtain because we're told what the price of each unit of labor is. So we're just going to multiply whatever is here by 120. So 2 workers, if we hire 2 workers, it's going to cost us $240. If we hire 7, it's going to cost us $840. But notice that this increases by just 120, okay? But before we even get to the cost, we can see here that the amount of output, you know, here increases, you know, the proportion at which this increases is more than that. So if we just think about marginal cost, the marginal cost is going to be falling up to the 4th worker, and then after, when diminishing return starts to take effect, it's going to fall. So let's calculate it. So how do we, I'll let you guys do it. So what's the marginal cost of the associated with the first unit of labor? And so we hire 1 unit of labor, we're going to get 4 units of output. What's the marginal cost of
30.
each? Yeah, so it's going to be 30. So we're just taking this change in total variable cost, which is 120, and then dividing it by the change in total product. And so that's going to give us 30. Here, we hire another unit of labor. We still only pay $120, but we get 12 more units of output. And so here we're taking the change in total variable cost, which is always in this case going to be 120, but now we're going to divide it by a much larger number. We're going to divide it by the change in the quantity, which is 12. And so then we get 10. So our marginal cost is falling as we expected up until the 4th unit of labor, and then afterwards it starts to increase. So there's an inverse relationship here between marginal product and marginal cost. They're actually like mirror images of each other. So when marginal product is at its maximum, marginal cost will be at its minimum. Okay, so just keep that in mind. And then now we have average variable cost. So here we've spent, on the first unit of labor, we got 4 units of output. And so, the average variable cost is just per unit, we're talking about per unit, is just 120 divided by 4. Okay, so again, we've spent $120 on labor. How much is that per unit? Well, we made 4 units, and so the average cost is also 30, same as the marginal cost here. So, on average, we've spent $30 per unit in variable costs. But now when we go to the second unit, the total variable cost is 240. So we've spent $240 on labor and we made 16 units. So for each unit, that's $15. Okay, and so the average variable cost is here, and we get a similar but opposite pattern here. So when marginal cost is falling, the average cost will also fall. So, or more specifically, when if on the margin the numbers are falling, that's going to be dragging down the average cost, and this is going to be below. It's falling, but it's going to start to increase, and then it'll hit the average variable cost at some point. They'll both be equal, and then this continues to increase, which will drag this up. Okay, so let's look at a diagram here. So on the top, we have our marginal product. We had that before. And on the bottom, we have our marginal cost and average variable costs. And so you could see these are like mirror images of each other. So where on this diagram does diminishing returns start to take effect? Anyone?
At 4 or 60 or 4 because it's productivity.
Yeah. It's actually both. Like, so if you're looking, at the 4th unit of labor, and we know that if you use 4 units of labor, you get an output of 60.
Yeah.
And so when we talk about, always remember, when we're talking about the costs, we're talking about in the quantity space here, the quantity and dollar sign space. So when we're talking about costs, it's per unit. That's why we're having quantity here. And when we're talking about product, we're talking about labor being on this horizontal axis. So so the marginal product comes up, maximum falls, marginal cost, falls and then increases. So they're just mirror images of each other. Same with the average product and average variable cost. So this is your minimum average variable cost per unit, and so that is also corresponds to your maximum productivity. So that's the cheapest variable cost per unit is if this firm made an output of 75 units. Okay, so these are the main. So we're going to be using this again in the next chapters because we're going to use this in the context of profit. Okay, so you'll get familiar with these. So you'll be using these again. So make sure you learn them well. But these are the main ones we're going to be looking at, the main cost curves that we'll be focusing on for our analysis. So we're going to be focused on the marginal cost curve. And again, the minimum of the marginal cost curve corresponds to diminishing returns. And other thing to note is that the marginal cost curve will hit the average variable costs and average total costs at their minimums. This we're going to call the most productive output. That's the minimum of the average variable cost curve. And then we just call this Q3 the minimum of the average total cost curve. We call that economic capacity. I guess you could think of this as the, like, this, when you incorporate the fixed cost as well, this is the best, this is the lowest cost per unit, including all the costs. This is the lowest cost per unit in terms of variable cost, but when we incorporate the fixed costs, this is the best. So we would, if you were to think about the long run and think about, suppose you have a really good idea, you're forecasting your demand and you think that your quantity would be something like Q3 in the future, you would want to pick a production, you would want to choose your variable, all of your inputs, the size of your plant or restaurant or whatever, such that you could achieve this low cost per unit, right? If you thought that the quantity you'd be producing or your demand would be very high in the future, maybe all the way up here, you wouldn't want a production process that gives these short run cost curves because your average total cost will be very high. So you would want to maybe increase your plant size or something like that so that you could think of these curves as being readjusted so that the minimum would be around where you are. But we'll talk about that again later too. It's more of the long run, but it's good to bring it up now. So that's the general pattern of the costs, general pattern of production. So we call the level of output that corresponds to the minimum short run average total cost as the capacity of the firm. And we're just saying it's the largest output that can be produced without encountering rising average cost per unit. Again, average cost per unit, that's going to give you that'll give you better profit. Like, the lower your costs are per unit, the better that is for profit. So anything less than that, we just call that there's excess capacity. There's, extra room to improve on to get a better cost per unit. Okay, these are, again, just for your study notes. The only, these are the total versions of the curves. We'll mostly be working with the three curves that we just looked at in the diagram before. But this is good just to go over and review for your understanding. And of course, total fixed cost is just a straight line. And so if we divide that by Q or output, it's just going to fall. So average fixed cost always just falls. It's not really, we don't really use it for much, so you won't see it too often. In most of the work or the analysis that we'll do later on, we'll just be using marginal cost, average total cost, and average variable cost. And we'll see if you can actually, if you have these three on there and you're given the market price, you could actually calculate profit right off the diagram. And so just to, finish up the lecture, if there's a increase in your, if there was an increase in the wage, for example, so that's a variable factor price, that would shift up your marginal cost and your average total cost curves, right? Or if there was a decrease in the wage, then they would shift down, just so you know. If you go back to that numerical example where we had the price of the labor being $120, and then we were able to get our cost curve, you can imagine if I changed that to 150 and then recalculated the cost curves, they would, in that case, if there was an increase, then the curves would shift up. Okay, everyone got your responses in? 3, 2, 1. Oh, we got 17 seconds left, I guess. Okay, all right, so yeah, the answer is D, so most of you got that right. So, if there was something about opportunity costs in here, something like that, then that would not be an explicit cost. Okay, and let me pull. Okay, go ahead. So implicit costs are costs that, which one is correct? Okay, 3, 2, 1. Okay, so it's giving you 15 more seconds. 5, 4, 3, 2, 1. Oh, I just noticed the chat. Sorry, I missed this earlier. Yeah. So yeah, Don, that's fine. And Pierre, the midterm will probably be multiple choice. I'm not sure yet. I may put a short answer question. We'll see how. Yeah, we'll see how it goes. I can probably get everything in multiple choice, so most likely it'll be multiple choice. Okay. All right. Let's see how you did. Okay. So most of you said A, and that's true. So B
Can you
is,
explain that?
yeah, sure. So, okay, so implicit costs are basically opportunity costs, or, whatever you gave up to run the business. So we talked about the entrepreneur giving up their salary, or, if they invested 100,000 into the business of their own money, we'd also want to include the, what they could have got on that $100,000 otherwise, right? So that's why A, A is the closest answer. Now B is not entirely true, because the quantity of output produced could be related to the accounting profit, right? Which would also, impact the economic profit. And so, yeah, so the implicit costs are generally these opportunity costs. So that's what the question was after, right? The A is the one that closely talks about opportunity costs, right? Does that make sense?
Thank you. Yep.
Okay. All right. So next, whoops. Okay. So next question. Let me set up your poll here. All right. So I'll let you read it, and yeah, we'll see how you do.
Did I lose your voice? Are you still talking?
Oh no, I had it on mute. Okay. Yeah. Oh, sorry. I got distracted there for a sec. Okay. So let's see how you did. Okay. Good job. Yeah. So most of you got it right. So here, the trick. I mean, so in this example, you had two implicit costs that were associated with the money that the person used to start up the business. Like if they were to start up the business, the money that they could use. So whenever you're selecting among opportunity costs, you want to select the best foregone alternative. So here, Mike would want to consider the $1,500 in foregone interest from loaning the money to Bob, because Bob was going to pay 5%, but his other, option would be to keep it in a savings account at 3%.
So really, wouldn't it actually just be a 900 implicit cost? Like I went with the 15, but shouldn't it be 900 because he was guaranteed the 400 either way?
No, because but either way, but that's both though are what he would. So the decision here would be to put the $30,000 into his repair shop. If he does that, he's giving up the interest in the savings account, the 3%, but he's also giving up the $1,500. You would always go with, what you're giving up would be the $1,500, because that's the best alternative. Like if you go, like it's just the concept of opportunity cost. If you
It was just my brain was trying to add them up together. I went with
because
15, but
because you could never get both. He can't invest the $30,000 in both of them at the same time. You can only do one or the other. So since you can only do one or the other, the one you're giving up would be the best one. The one that's less, it's not the opportunity cost that's relevant. It's your next best foregone alternative. If you
okay, yeah, I just running my brain all over the place.
no, that's good. That's a good way to learn. Yeah, no, that's perfect. Yeah. So the correct answer here would be D. Okay, so next question. Let me get your poll here. So now you get to practice determining where your diminishing return starts. Okay, there you go. So here you'll want to think about calculating the marginal product. You don't have it given to you, but you'll need to think about it, how to calculate it using the table. Okay. Okay, 15 seconds left, 10 seconds, 2 seconds, 1. Oh, okay, so you get 20 more seconds to enter your responses the way this is set up. Okay, let's see how you did. Ooh, okay, so, all right, let's look here. So what's the marginal product of going from 0 to 1 units? Well, it's 10. What is it for going from 1 to 2? You guys tell me.
20.
Yep, 20. And then we know it's huge when it goes from 30. Yeah. And then we can see right here, this is not 60, right? It's less. So then we know it happens here. This is 32, right?
42.
Or 42, sorry.
Yeah.
And so this here is when it first starts to decline. So it's between 3 and 4 units.
4.
Right, here's your next question. Okay, go ahead. Okay, 15 seconds. Okay, let's see how you did. Okay, good job. Most of you got it right. Yeah, I mean, so after the second barista, they started to experience diminishing returns because this is 15, the difference, right? And between 40 and 70, the difference is 30. So it went from 30 to 15, so it's declining. Okay, question 6. Let me get you a new poll.
Technically declined from the first to the second, going from 40 to 70, because the first hour is 40 and then 30.
No, so the first barista produced in 40, right? And then the second one, production went up to 70. So the difference here is 30, right? So the marginal product went from 30 to 15.
Okay.
Yeah. Okay, so, oops, hold on one sec. Let me just redo this here.
I think I'm only seeing part of the question. Total product is increasing at an increase.
Oh, okay. Okay, I'm just going to shuffle this up a bit because you saw the answer. Give me 1 second. Okay, go ahead. Okay, 15 seconds left. Okay, let's see how you did. Okay, so, 4 of the 9 of you got it right. So, when we go from 0 to 1, we get that total product increases by this amount. Then it increases by this amount. All these are for 1 unit increments, right? So we can see here that all these lines are getting bigger, right? Now, well, you'd want to look at, you'd want to look at the differences here, sorry. And so, these are getting larger, but then now they start falling, right? Okay, this could go down. So this is the inflection point here. So I remember I talked about this in the lecture. So on the total product curve, when this is, convex and then becomes concave, this is increasing at an increasing rate. So that means your marginal product will be increasing. And then this is the point of diminishing returns here at the inflection point, because now this increases, but at a decreasing rate. Okay. So the correct answer is C. Okay.
Sorry, could you explain that again? I kind of missed it.
So when you have, so this is the total product curve. So when I go from 0 to 1, this, total product increases by this amount. When I go from 1 to 2, the increase is by this amount. Then when I go, 1 more unit, it increases by this amount compared to the previous unit. So these are getting larger. So, every time we hire a unit of labor here, we're getting more and more output, which corresponds to increasing marginal product. But after the inflection point here, this starts to fall. So I didn't do this quite properly, but
What is getting larger? What is getting smaller? What's falling? Because all I'm seeing is squares.
Okay. Yeah. So, okay. let me clear that off. So here, as you're increasing labor, your total product is increasing at an increasing amount, right? So that means that your marginal product is increasing. So this question is just asking total product is increasing at an increasing rate in which range? Well, it's doing that in the range from, you could either say from 0 to 7 or from, in terms of the labor, or from 0 to 140. So it's this thing here, when it has this shape that it looks convex or it's curving this way. It's hard to do this without calculus, but this is increasing at an increasing rate because if you think of lines tangent to this, they're getting steeper and steeper. But you don't need to know that. It's just, this is, think of like it's growing exponentially. So, this keeps getting steeper and steeper and steeper, right? And so that corresponds to total product increasing at an increasing rate. If it were not increasing at it.
Okay, could you, just one quick second, where you're saying it's increasing, could you continue the line if it was to continuously increase?
Oh yeah, so, okay, that's what I was about to say. I was saying, if this was so you could either have it increasing at an increasing rate or increasing at a decreasing rate or just increasing constant, the same thing. If it was increasing constantly, it would just be a linear, it would be a line like this. Whoops. I'm going to clear this off. Does it let me do it? I'll do it. Here, let me just So if I draw a perfectly straight line like right there, you can see how it's you know what I mean? It's getting steeper and steeper and steeper. And then after the inflection point, it's getting flatter and flatter and flatter. So if it's increasing at an increasing rate, it has this shape. And so, you know, the amount that this is getting larger, the total product is increasing, right? As you go from 0 to 7 units. I don't know how else to, yeah, it's just, you know, if you look 0 to 1, you get this little increase, and then you go up this amount, okay? And then if I draw a line over here, I'm going up this amount. And if I draw a line over here, I go up this amount. Every time I'm going up, that amount that I'm going up is getting larger and larger and larger. If you did that same exercise here, you would see that that's getting smaller, smaller, and smaller. That's all. Don't worry too much about that. It's not the, you know, it's probably not the best question anyways. The key, I should have put, it would have been better to just ask you where the point of diminishing returns would be. And you know that, right? It would be right at that inflection point. Because after this point, your marginal product starts to fall, marginal product is increasing. And the best way to see it is on your own, just to, if you were to have this and then below draw the marginal product based off this. So the marginal product would be those lines that are increasing, like I said. So between 0 and 1, you would have this amount. You can't get the exact number though, but you know, you can see that when you go from here to here, that would be higher than that. And if you were to plot those below, you would get the marginal product. You can just look back at the lecture slide for this. It's just going off this idea here. Or actually, I think the other one I had was better. Here. So this here is the same point, right? And this is the point of diminishing returns. If I were, so here you have the numbers, you can calculate, oh no, it's not exactly clear, but you can see as I go from 1 to 2, the marginal product is this point here, which corresponds to this vertical distance. When I go from 2 to 3, the marginal product increases from this vertical distance, and that would be this point. So it's increasing and then falling. Okay, that's all it was just getting at. I should have wrote this question to ask you what this point corresponds to. It corresponds to the point of diminishing returns. Is that okay?
Yeah, I get it.
Okay. All right. So here you have 3 curves. These are I'll give you the hint. These are the total cost curves. Okay, there was 3 of them. We had them in that one diagram. So it's just asking you what the correct names are for these. Okay. Okay, go ahead. So as a hint, there shouldn't be any average costs here, right? And also remember that your total costs will be the sum of total fixed costs and total variable costs. Okay, sorry, it's almost out of time. Here, do you want me to open that? Oh, you have 15 more seconds to get your answers in, sorry. Okay, let's see how you did. Okay, most of you got it right. Yeah, so here the correct answer is D. So this is the total cost curve, and we know it has to be the highest because it's the sum of 2 other curves, the total variable cost and the total fixed cost. Total fixed cost is just going to be horizontal because it doesn't vary with output. It's just a fixed number. Never, you know, your rent doesn't change depending on how much sandwiches you produce and sell if you own a sandwich restaurant. Okay, next question. Okay, go ahead. So these are the 3 important product curves, which letter correctly corresponds to these labels here. And actually here it has your total, so one of the total curves is in here too, the total product curve, and then you have the other 2, per labor curves. Okay, 15 seconds roughly. 5, 4, 3, 2, 1, and 0. All right, let's see how you did. Okay, so 3 of you got A is actually the right answer here. So so if we go back to the slide we were looking at, this is the total product. This is your marginal product. So the marginal product always comes up and then hits the average product at a maximum. So this is your marginal product, that's your average product, and then this is your total product. Okay, next question. Okay, go ahead. Okay, 15 seconds, 5 seconds, 3, 2, 1. Okay, so the correct answer here is B. So if there's diminishing returns, then we know the marginal product curve is eventually going to fall. When it starts to fall, that's diminishing returns. And we know that if the marginal product curve is falling, it's going to start pulling the average product curve down.
That's also called negative returns?
No, the negative returns, let's go back to this. So marginal product, when it starts to fall, it's going to hit the average product, and then as soon as it gets below here, it's pulling the average product down. So because of diminishing returns, you're going to have marginal product at some point falling. And so since it starts to fall, it's also going to drag the average product down as well. If you never had marginal product falling, it just continually increased, then average product will continually increase as well. Okay, let's do these last two. Open poll. All right, so you're given a chart here. You have your marginal cost, average total cost, average variable cost, average fixed cost, and it says at output level Q, which one of these are true. Now, marginal product isn't on the diagram, but you remember there's a relationship between the marginal cost and marginal product. They're like mirror images of each other, right? So if marginal cost is increasing, then marginal product must be. Okay, 5 seconds. Okay, good job. You all got it right. So yeah, it would be falling. And last question. All right, so we have the same diagram, and it's just asking you about the vertical distance between the average total cost and average variable cost. Okay, so remember there's two things that sum to one thing here.
The poll is up.
Oh, okay, go ahead. Sorry about that. Okay, I think everyone's got their responses in. All right, so good job. So we know that average total cost equals average variable cost plus average fixed cost. So the difference between average total cost and average variable cost is, reflecting, that difference is the average fixed cost. Okay, because, these two here sum to this one. So average total cost equals average variable cost plus average fixed cost. Okay, so I think, we'll call it a night.